South Africa faces significant economic and political challenges. We will be lucky to see any economic growth this year due to load shedding and widespread corruption, and this has of course pushed down business, investor and consumer confidence levels to record lows. This could result in investors taking emotional decisions, which could be very costly. In this session, we will discuss how investors should look at opportunities in the local market, or whether it makes investment sense to instead look at other markets around the world. Now, I've got two heavyweights participating in this panel. Karl Leinberger is the Chief Investment Officer at Coronation, and Duncan Artus is the Chief Investment Officer at Allan Gray. Karl, gentlemen, thank you so much for your time today. Karl, let's start with the views of South Africa, because confidence levels are really, really low. And how do you see the debate between some advisors, some asset managers saying, listen, take everything offshore, there are too many political risks in South Africa, versus the other side of that debate, listen, the JSE offers value, do not be overexposed offshore?
Yeah, I think the first thing is that there's an enormous amount of emotion right now. All citizens in South Africa would be feeling it. It doesn't matter where financial markets or not. And if you're going to successfully invest, you need to take emotion out of it. You need to be very careful when emotion is high. And I think right now, South African asset prices are on fire sale. And I think to make the argument that you don't own any South African assets, which are, in my opinion, extremely cheap, I think would be an error. At the same time, there are enormous risks for the country, for the fiscus, for the sovereign, for all citizens, and to not avail yourself of diversification, it would be a big mistake. So we very much have a balanced exposure, taken almost the full 45% offshore. We think that there are big opportunities in local markets, but we also think there are big opportunities in South Africa, and we think, to achieve some balance between the two makes sense right now.
Duncan, your views?
Yes, morning, Ray. I think just a thing we've got to think, of course, is the South African stock market is dominated by offshore shares. So just Naspers, Restaurant, BHP and Anglo are about 40% of the index. So, the effective offshore weight of most portfolios is a lot higher than it appears when you look at fact sheets. But I concur with what most of the people says. I think we're thinking a lot about risk in the portfolios. Are you buying value trades? I think Karl was with me at the Bank of America's conference in Sun City. The companies were pretty bleak there. So I think, looking out to around 2024 is going to be the important thing, because I think the earnings are still there in 2023. But I think the year after is going to be continuing for South African companies. But the other sort of count that is, if I look at the market caps of South African companies in dollars, many of them, it just seems too small. So the South African stock market has gone nowhere in 16 years when measured in dollar terms. So that either tells you our stock market's very poor, or it tells you there are probably a lot of opportunities.
Do we see the performance of the local market, relative to other emerging markets? How does it compare? Karl?
I think the one point I want to make on that is I think that I really don't like the industry's tendency to see South Africa as an emerging market, to obsess about that, to argue, for example, that you can't have emerging market exposure because you live in an emerging market. I think South Africa has very little in common with, for example, Asia. And just because some MSCI benchmark has lumped us together, I really would caution South African investors from looking at the SA market in the same light as other emerging markets. I think we're just so different. We're long commodities, they're short. They're highly productive nations growing strongly. We are unproductive and not growing. Debt levels are much more manageable in many of those countries. We have worrying levels of indebtedness for the sovereign in South Africa. It's just so different. So I'm quite cautious whenever to frame South Africa and the uniqueness of our market in the context of emerging markets. I think one has to be very careful. I don't know if that answers your question, but it is a particular sort of bugbear of mine. I think people must be careful of it.
But still, South Africans who are living in South Africa and who are investing, they're saving for retirement. This is a difficult debate because the prospects, is very uncertain. What will happen? We have some severe economic problems at the moment. Now, obviously, the performance of the economy is not a benchmark of how investment markets will perform. And there is emotion. So how do you think South Africans living here, let's take my age, I'm around 50, and I've got some significant investment life in me, I hope. How should I look at this? How much offshore, how much local, and how do I strip out the emotion of that decision?
There's definitely no generic answer to that. So the answer, for example, for a high net worth South African that wants to live an international lifestyle, the kids are going to go to overseas universities, they want to travel once or twice a year, that's completely different to the average South African who's retiring on a 7% drawdown, and their primary focus is ensuring that they don't outlive their capital. So I think we must be super careful of generic answers. I think the high net worth South African can afford to take very strong views. They can afford to be wrong. They can afford to mismatch assets and liabilities. They can afford to have all their money offshore and take the stress out of it. I think the average South African who's actually retiring in quite a tight situation needs a very healthy offshore balance. And in our balance fund, we're currently at 44% offshore, but they also need domestic assets which match their liabilities where they will be over the coming decades, which give high yields, which takes a lot of the volatility out in their portfolio, and which to some extent does give some protection from cost of living that's escalating every year by 6 or 7%. So it depends who you are, depends on what your drawdown rates are. I think diversification is important. And for your average South African, I think a balance of domestic and offshore makes most sense.
Duncan, what are your views on that?
I echo most of what Karl says, but the one thing I would say is the biggest mistake I've seen individual investors make over my career is definitely the offshore-onshore thing. When the rand's very weak, the news is pretty poor, you take money out at a bad exchange rate and you buy the NASDAQ at 5,000 in 2001, and then you bring the money back when the rand's 5. So people make big mistakes, and that's why I think your sort of point on emotion is right. I agree with Karl that we don't really look at it as South Africa versus the rest of the world, and I think it's important that when people talk about the rest of the world, actually almost most of the stock returns over the last 12 years have just been driven by US equities, and within US equities was a number of mega cap tech shares up until the last while. I mean, in Europe, maybe LVMH, L'Oreal, maybe a couple of companies. Most Asian stock markets in dollars are still, flat, just like South Africa. The European index, when measured in dollars, is lower than 2007. So I think you've got to be cautious when you just say, oh, South Africa's bad and the rest of the world's great. Actually, most of the returns have been driven by these big companies in America that have actually been able to grow earnings in dollars. There are very few offshore companies over many years that can grow their earnings in dollars. But I think you're right about the emotion. I think people have subtracted substantial portion of their returns by taking money offshore or onshore at the wrong times.
Yeah, I think your remark regarding timing is critical. And I would assume we are now in that situation where the rand is weak. There are significant concerns about what will happen in South Africa over the next few years. Is this now a period which you caution against for taking money out?
No, so we're not quite as high as Coronation. We're sitting sort of 34, 35% offshore. But if you add the dual listed companies, we're probably close to half offshore. I mean, I think about it slightly different, Niekerk. As Karl said, it all depends on individuals and what your risk is. If you can afford to hedge the tail risk, that's great. I mean, I don't worry about the rand going to 20. I worry about the rand going to 1,000. And if you think that sounds bad, just go and look at some of the countries MTN have invested in, or just go and look at some of the African currencies that the South African corporates have been caught in. So it's really a massive devaluation that hits you in one day, because then you have no chance to react. So we always think about hedging that sort of side of the currency risk.
But Karl, the facts are the S&P 500, the absolute return was around 12% over the past decade, and in South Africa, the ALSI over the past decade showed growth of 3.2%. In dollar terms, just over 10% in rand terms. So if you just look at the historical performance of the past decade, it suggests that offshore markets will perform really well, especially US markets. So obviously that is in 2020 hindsight. But how do you think people should look at those facts and incorporate it within their strategies?
Yeah, you want to distinguish in investing between the rear view mirror and the windscreen, right? So I mean, for sure, South African markets have done poorly over the last 10 years, and global markets, and as Duncan says, mainly the US, have done really well. So why has South Africa done badly? Again, difficult to answer because we've got global stocks listed here, we've got commodities, we've got domestic stocks. But certainly, I think for the domestic stocks, the big reason is the very poor performance of the economy over the last 10 years and very, very high prices 10 years ago for domestic assets. And 10 years ago, we were super, super negative on SA equities as an asset class. And, we strongly cautioned clients against exposure. We ran incredibly low exposure. So in our balanced fund 10 years ago, we were at 55% in equity. We're currently at 74% because sure, the economy is not performing well, but asset prices are low. And that's the big thing you've got to get right in investing is you've got to be able to understand the economic environment. You've got to understand what's happening to the economy, what's happening to businesses. But then you need to look at what you're having to pay for assets. And if asset prices are low, you're just in a much better place than when you're having to pay a high price for them. And so the key point I would make is that we are much more positive about JSE equity exposure today than we were 10 years ago because today prices are low.
Yeah, Duncan, I'm sure you agree with that because your foreign exposure is lower. But is that pretty much the way you also look at the market?
Yeah, so I think Karl makes a good point. People forget South African equities outperformed the S&P and the world index by quite a few factors from 2002 at the bottom to 2010. And we've roughly been underperforming since 2010. And I remember in those years, exactly like Karl said, in 2007, we were saying, you should take your maximum offshore and South African equities are expensive. And they still went up for another 3 years and all the investors were pretty unhappy. So it shows you how the psychology can change. But I think if you look outside the dual listed shares, it's very hard for South African companies to grow profits because you're basically only growing by taking market share from someone else. Either Shoprite's growing at the expense of Pick n Pay and Woolworths, or Tiger Brands is growing at the expense of AVI. There's not this sort of cake that's growing at 5%, sort of 5% real. But people know that, and so valuations are pretty low, and profits haven't gone up a lot over the last few years. So if you want a positive, the biggest positive about South African equities is that it's so bad, right? Because you just need to get a little bit better. If profits expand and people put a higher multiple, you could see reasonable returns from South African equities. And I personally think the dual listed shares in South Africa are far more attractive than the mega cap tech shares in the US. So I think you could also eke out a few basis points over there. I think Karl might disagree with me on that, but we think some of the, things like AB, InBev and British American Tobacco are pretty depressed versus the big American stocks.
Yeah, and in many ways they are international stocks. So, sorry, Karl?
I think what Duncan was saying a little bit there, and he said in his earlier comment, which we very strongly feel, is that there are times in markets where the benefits from stock picking are not easily felt. Sometimes even the returns from stock picking are low, and then there are times when there's an outsized, the potential for outsized return from stock picking. And we definitely think that this is one of those times, because as Duncan was saying earlier, there's a lot of value traps in South Africa right now, where you're seeing stocks on 7 or 8 times earnings, where you think they're on 7 or 8 times earning. They look really cheap. They haven't traded at these levels in a decade or two, but the earnings base is going to take massive pressure in the next 2-3 years because the economy is weak, the costs of business are going up, maybe they're losing market share. And conversely, there are businesses that are either taking market share or are better businesses than the market acknowledges, and trade on low multiples, and they're going to be great investments. And so you're trying to as an investment team get that right. You're trying to make sure you're correctly avoiding the value traps and finding the very meaningful value that there is in many stocks. And so I think this is a stock picker's market.
Yeah. I would like to hear from viewers. Send emails with questions to events@moneyweb.co.za. If you're watching on YouTube, just use the chat box and I will put the questions to the panel. Duncan, of course, we are talking about equity markets at the moment, but the South African investment world is a lot bigger than that. From a risk perspective, a local risk perspective, do you also, have you changed your asset allocation model within your multi-asset funds just to try and reduce the risk?
Yeah, so we think about, as I mentioned, we think about risk a lot at the moment, and you haven't mentioned, I think, the sort of elephant in the room in the asset management industry, and to my mind, certainly when you take part in panels like this, and that's South African government bonds. I think it's a very consensus view in the South African asset management industry that South African long bonds are very attractive. You get a 10.5 to 11% yield, inflation goes back to 5, you're getting a 6% real return. Why bother even analyzing any equities? And we can see that the flows in the retail industry mainly go to the fixed income and income funds. And one of the things we did correctly, I think, over last years was, we reduced our duration. So we're not quite as bullish on South African long bonds as I guess the industry consensus is. The yield curve has flattened quite a lot. We can get almost 9% on a 1-year note with a bank. So we've moved, a year and a bit ago, we moved quite a bit more into floating rate sort of debt and into sort of shorter term paper. And then I think the one thing that's important from a risk and asset allocation point of view is China. So our stock market is massively exposed to China through Naspers, Richemont, and the commodity companies, and indirectly because South Africa only runs a surplus when commodity prices are high, and China tends to be the main buyer of those commodities. So, I mean, it's an extreme situation, but if you wake up and China invades Taiwan and we get a Russian scenario, South African portfolios could take a real hit. So that's why we like owning something like British American Tobacco. It has zero exposure to China. The AB InBev only single digits, where something like Richemont and the commodity companies and many of the global consumer companies, Apple, Nike, Starbucks, Disney, most of their growth comes from China. So that's something we think a lot about in the portfolios as well. And what we also did was we've introduced a hedge in the portfolio. So that's one of the things that helped performance last year. We had roughly 10% of the portfolio hedged offshore, which produced an 11-12% in dollars when you took big losses in equities and bonds. So there are other means that you can sort of play around with your asset allocation to try to protect against risk, especially when you don't see a lot of value across all asset classes.
I want to come back to your remark about external risks. But Karl, your views on bonds and diversification also through a change in asset allocation?
Yeah, I agree with Duncan. We, as a team, are obsessing at the moment with the debate of what happens in South Africa 5 to 10 years from now and the risk that we find ourselves in a debt trap. And were that to happen, do you go the financial repression route? Do you allow inflation to run? Or do you go the quantitative easing where the central bank just becomes a massive buyer of government bonds? Or do you default, restructure? Where do you want to be? Do you want to be in cash? Do you want to be in fixed rate bonds? Do you want to be in inflation-linked bonds? We've incredibly carefully gone through every single major default in by global sovereigns since 1960, trying to work out the lessons where you want to be positioned. I definitely agree with them. It's not as simple as saying you're getting 11% yield and you can buy bonds. In our balance funds, global balance funds, we're seeing about 13% in government bonds. So we don't have that's a big underweight. And then we've been quite careful about where we are on the yield curve to try and manage these risks. I think these risks that Duncan and I are talking about there are completely irrelevant over the next year or 2 or 3. But I think the investor who ignores the sort of longer dated risks, makes a big mistake. So I agree with them. I think it's nuanced. I think it's difficult. I think there's so many known unknowns, so many unknown unknowns. Certainly, I'd echo what he's saying, that if you aren't thinking carefully about those risks today, then you're failing your clients. And certainly, it's one of the most hotly debated issues in our team. We take a constant poll. We've been doing it 2 or 3 times a year for 5 years already as to whether or not, in our investment time horizon, South Africa finds itself in a debt trap. And the team is quite split on the issue. But yeah, certainly we're very mindful of it, and I agree with him. It's not receiving enough attention in the industry debate.
But did your team, through their views, is there a bit of a consensus view of what could happen and what should be done now to try and mitigate that risk?
No, there's no consensus, because there's a decent part of the team that thinks we can muddle through this, which so many countries have successfully done over the last decade. And then there are people like myself that are more worried. Typically bankruptcy works in the following way, that it happens, incredibly slowly, and then it happens enormously quickly. Your day of reckoning comes with absolutely no warning. So, there are a lot of people who take comfort from the fact that, we seem to be muddling through these things. But I think already our levels of debt have become unsustainable. And I think trying to navigate that as the sovereign over the next 5 to 10 years, that's going to be enormously right. And I think it requires a lot of things to go right for it not ultimately to manifest in some kind of crisis at some point in the future. Very unlikely in the next few years, but certainly, within my investment horizon, I think it becomes an issue.
Duncan, those are harsh words. I don't like the term bankruptcy. Obviously we have a fiscal problem in South Africa. It's probably still manageable, but as Karl said, if it gets worse, the slope, the angle of the slope can, worsen quite quickly. How do you view this scenario?
So Rick, we've got quite an interesting lens to look at it, and I know Coronation did this too. I think we run the world's biggest African bond fund. So, when you look at Angola, when you look at Senegal, Uganda, Ghana, Nigeria, we've done reports on all these countries, and it's quite interesting because, if you look at the US, you can't just forget about their debt and that. But when you're Nigeria, when you're Ghana, you can literally run out of dollars. You run out of dollars. And, if you think Kenya is one of the better run African countries, you can just go and look what's happened to their currency at the moment. So I think Karl's right. It'd be very naive to think it can't happen to South Africa. We've kind of been saved a little bit, in my point of view, by 2 things. One is we have a very sophisticated financial services sector. So when our dear President, Mr. Zuma, changes the finance minister, you wake up on Monday and the bonds have moved massively, and the bank, insurance, and property stocks are all down 20. And the Treasury Department can go, and the Reserve Bank can point to the government and say, look at what you've done. That doesn't tend, the other countries don't have as deeper financial markets. The other one is we have quite a resilient private sector. It's quite incredible when you speak to some of the companies now, after all the mismanagement of our economy and a no-growth economy, some of our companies have run pretty well, and the management are really resilient. And one of the trends we're seeing is private companies are just taking over from the government. The one thing we're very careful of, I don't know if Karl has the same problem, but a lot of the fund managers here live in Cape Town. And last week, we were in Johannesburg and then driving to the northwest, and I was, please take me back to my Cape Town bubble. That's what I was thinking, right? So we've got to be very careful that sitting in Cape Town, we don't underestimate the problems in the rest of the country. But interestingly enough, our Africa Bond Fund, I haven't checked recently, returned the same as the all-share index over like 10 years, despite all the problems. But then you were starting with like 15, 20% yields. And obviously South Africa can't afford that at the moment. The one thing Karl didn't mention was next year's an election. And I was fortunate enough to vote in the first democratic election, but there's a chance for my first time as an adult, we're going to have a country with no majority government. And if you look at the way the cities are being run, it doesn't give you much hope about coalition government. So that's another risk I think the foreigners might be waiting. Because, if yields go high enough, foreigners will fund our government. It's just whether we don't want to get there.
I think another positive you can add to the list is SARS, because SARS has overperformed or performed above budget now for a few years. And of course, the more revenue we get as a country, the more favorable our fiscal ratios will look. But gee, my hair is almost tingling in my neck, because we've got a lot of external risks. You've referred to the war in the Ukraine. In an earlier discussion, it was made very apparent that the impact that war could have on the world could be significant when it ends, because it will depend on how it will end. The impact could be felt far and wide. We have interest rate cycles in the rest of the world, which are pretty aggressive. So there are many risks facing South Africa at the moment. What of those risks are you the most concerned about? What do you think could have the biggest, let's call it medium-term impact on South Africa? Would it be foreign risks or domestic risks? Karl?
I think the quick answer to that, I mean, you've thrown so much at the problem here, and as Duncan says, a lot of South African companies and citizens are resilient, and they're still sort of finding ways to carry on. I mean, I think it's not like we've got a prosperous system and we're asking what could break the system. We actually have a system that is failing, and already we've thrown so much at it. Probably the biggest risk in the next year is just that Eskom deteriorates meaningfully from a already poor level of performance. I think I'm almost a little less worried about South Africa, just because so much bad has already happened, so much bad news is in the price. Probably the biggest worry for me from a global perspective is just inflation, interest rates, the risk of recession. These are all things that global economies and global investors have not had to deal with over the last decade. And the consequences of those, all of which I think are, the risks are heavily skewed to the downside, that's going to be a lot for global markets and global economies to absorb. So I think that's also very important in this debate to bear in mind. As much as South Africa has its own challenges, you don't need to explain that to any South African. We're all aware of it. Internationally, there's a whole lot of risks that are no longer sort of academic debate. They're sort of actually playing out before our eyes, whether it's geopolitics, whether it's inflation, whether it's interest rates, whether it's over-indebted sovereigns. These are all very real risks in global markets right now.
I think let's draw a line under risks, because South Africa does not have a monopoly on problems. I think there are many other countries facing probably different problems, but it will also affect investment markets. Duncan, if you look at the local market, a current recurring theme was it's undervalued, or it offers fair value, and there are several sectors and companies within those sectors that offer value. Where do you see the opportunities, and can you maybe mention a few companies you are actually investing in right now?
Okay, Rex. So just let's caution that our big stocks are all the multinationals. So, British American Tobacco, our biggest purchase over the last 2 years has been AB InBev. Then we own Glencore. And I think what we look for when it comes to domestic stocks, ones that are focused more on the South African economy, is self-help stories. So if we go back a couple of years, you look at Woolworths, the huge problem in Australia, the clothing business not doing well. We spent a lot of time trying to prove that David Jones was worth at least zero, because people were valuing it at minus like 10 billion rand, and then you had the clothing business where the margins were pretty low. And Woolworths has been a fantastic investment since then, and it's because there was something they could do. So generally when we're looking at local companies, it'll be, do they have something that can enable earnings to grow outside of a low growth economy? And as an example, I think, Coronation, I think if you still Karl can correct me wrong, they prefer FirstRand, we have Nedbank and Standard Bank. Standard Bank's Africa story may or may not work, but at least it is something that's independent of the South African economy. And then I think there's some things which are just dirt cheap. If you look at the hospitality sector, so our clients are invested in Sun International, Tsogo, Southern City Lodge. If you convert their market cap or their market cap plus debt into dollars, for Marriott or someone, they could buy them with pocket change, and you'll be getting these huge businesses sitting over here in dollars. And I do think if South Africa works other than commodities, what we've certainly recommended to the government is travel. At Cape Town at the moment, here at the waterfront, it's just packed with foreigners, and that's a very labor-intensive sort of industry. So self-help stories in South Africa, and some things which are just very cheap. I think the hard thing to call at the moment is commodity prices, because obviously all the big diversified miners are all on single-digit multiples, but obviously those prices have been coming down. And when commodity prices come down, it's also likely that the rand would weaken. We go back to a deficit, and that puts pressure on the local economy. So you asked Karl earlier what his biggest risk is. My sort of biggest risk would be a true implosion in China, because I think that's the biggest bubble in the world. But I've thought that for 16 years, so you don't have to listen to me on that one.
Yeah, that is indeed a risk, and it's also not only for South Africa, for many countries around the world, probably the world economy as well. Karl, what is your proof in the pudding? Where are you investing now, and what are you staying away from?
I think unfortunately it's a very difficult question to give broad brushstroke answers to. I think the stock picking is particularly important. So for example, I'm not that bullish global equity indices, but I think there are so many stock picking opportunities, so many companies are just being completely mispriced in an environment where factor-driven investing is just driving share prices. And I think that if you stock picker with a 5-year view, I think you can find so many stocks that are going to do incredibly well. In South Africa, I think there are significant stock picking opportunities. As much as the economy is performing poorly, there are some businesses that are growing strongly, either because they're taking market share or because they're in growth industries, for example, private education. I think that you have to be careful of SA bonds, but I think, for example, in the global credit space, there are amazing opportunities to buy well-capitalized businesses that are trading where you can buy their bonds at sort of 8 to 10% yields in hard currency. So I think that when people are worried, it's a good place to be. Okay, what you don't want to be is in a market where no one's worried and everyone's high ego and overconfident. And right now, whether you're a South African investor or a global investor, all we'll talk about is the risks, because the risks are real and there's lots to be worried about. But consequently, asset prices are low. And I think that if you're with a manager that has proven stock picking skills, that thinks long term, I can't believe that manager won't put a balanced portfolio together that will deliver really good returns over the next 5 to 10 years. And that would be sort of my summary of the kind of markets we're in. And it's why, as much as there's so much to worry about, we actually are quite confident, and why our balance funds are actually sitting quite high in equity, whereas 10 years ago they were really low.
Gents, that's all we have time for today. Thank you so much for sharing your insights. I think will remain in a very nervous period, especially the short term. Of course, it's very difficult to invest, for the short term. But I think what will happen over the next few years, and especially if we can recover from our electricity challenges, it will impact long-term investments. And good luck with your job. Good luck with managing people's retirement money, because your success will determine how well they can retire. But again, thank you so much for sharing your insights. That was Karl Leinberger. He's the Chief Investment Officer at Coronation, and Duncan Artus. He is from Allan Gray. Gents, thank you so much for your time today.